Welcome to another episode of Real Estate Investing Explained. Here's today's question. Let's dive into analyzing specific potential investment property. What type of neighborhoods are you looking for and why those specific neighborhoods?
Yeah. So looking back with the way that we are in the market right now in 2019, in 2015, 2016, I invested in Jacksonville, Florida in C- areas. I wouldn't do that right now anymore. I would invest. So now for example, if I'm going to be investing out of state, I'm going to invest in B areas because right now, the way that the market is right now is getting a little bit high. I want to get some good quality tenants in a good quality home. It doesn't have to be an A home, but I just don't want to be in those C- areas where the tenants may not pay and then I have to evict them. And then it's going to cost like $2,000 to fix the property again and then evict somebody else in like 9 months and stuff like that. I don't want to deal with that. So for example, I bought a couple of homes in Florida for $24,000 in C- areas. And now I was able to sell them for $50,000. I wanted to get rid of them. So now I'm going to be investing in B areas.
For someone who might just be hearing these types of classifications for the first time, can you break down what a C- area is, a C+, maybe a B, B-? What does all of those gradings mean?
Yeah, some people may have different ways to look at it, but the best way to see it is an A area is highly desirable. They may have new homes, maybe not as new, but it has the best schools. People are willing to pay extra just so that their kids can go to those schools. And those areas are super expensive. B area is going to be more of an area where the schools are fine. It's still close to a lot of different things. The homes are still good. Like it's not great, but it's good. And anybody will be comfortable to live there. And then the C- areas or the C areas are areas where people might be walking a lot around the streets. There may not be any HOAs, and then they have some trailers right there on the street. Or you go into a subdivision and there's cars, old cars in the grass kind of thing. And you're like, okay, I don't want to really live here. Or they might have like all the streets may just be packed with cars. Those would be areas, and where the homes are super old, they're not well taken care of. Those will be more like C to C- areas, or maybe even D areas.
Yeah, so as you start getting down close to C-, you're really getting close to that D+, D+ area, which is not necessarily the best areas to be investing in. I mean, you can make some pretty good cash flow and you can get low priced properties, which is good for a lot of new investors. But what's often overlooked is that those are generally pretty high risk areas. And on paper, the returns might look really good. But when it actually push comes to shove and you're actually buying and renting out that property, if you don't end up getting the rent because the tenants aren't of high enough quality to be able to afford the rent, then those returns don't actually materialize. And essentially, you just own a property that isn't getting those returns that you expected. So you mentioned you don't go any lower than B. You're looking for more B now. Would you do anything lower than that if you're local, or do you really stick to a B, B- area?
So right now I'm sticking to B- to B areas, right? Okay, when you invest in a B area right now, people that used to live in the C areas and now they're doing well, they have some money saved, they would go to B areas. And if the economy comes down, A tenants would go to B areas. So it's sort of like that space, those homes where in a good economy, the C people are becoming more B types of tenants, which is great. And then if the economy goes down, the A people are totally comfortable with going into a B area. So it's sort of like the safest for you also long term.
Eventually, when things do turn, I feel like it's a price point where a lot of people can still afford it. They're comfortable living there. The amenities are good. Location's good. Perfect. It's not the best, but it's good enough. And so that when things do turn, those in the higher B class or even A minus class that may have a spouse or an individual in the home lose a job, they're able to still afford that level of income and still have a safe place to live. That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.